Ever wonder how some people retire in their 40s or even 30s without working another day in their lives? One of their biggest secrets is dividend investing. Dividend investing allows people to make money passively. Every time you buy a dividend stock, you're not just investing, you're creating a stream of passive income. These companies literally pay you just for holding shares. No selling, no guessing the market, just steady, consistent income. Now, why does this matter? Because unlike regular stocks that go up and down, dividend stocks pay you regularly, whether the market is booming or crashing. It's like having a side hustle, but without the extra work. Even better, if you reinvest those dividends, your money grows even faster. Over time, this can turn small investments into massive wealth. And guess what? You don't need a fortune to start. In this video, I'll show you exactly how to invest in dividend stocks, even if you're a beginner. Chapter 1. What are dividend stocks? So, what exactly are dividend stocks? Let's keep it simple. When you buy a stock, you're buying a small piece of a company. Some companies share their profits with investors. That's called a dividend. Think of it like this. Owning a dividend stock is like owning a rental property. Instead of collecting rent from tenants, you collect dividends from companies. The best part? No tenants to deal with. Dividends are usually paid every 3 months. Some even pay every month. The more shares you own, the bigger your payouts. For example, if a company pays $1 per share annually and you own 100 shares, you'll get $100 per year just for holding the stock. But not all companies pay dividends. Some reinvest their profits. So how do you find the best ones? Chapter 2. How to pick the right dividend stocks. First, check the dividend yield. This tells you how much a stock pays compared to its price. A 3% to 5% yield is usually solid. But if it's too high, like 10% or more, it could be a red flag. The company might be struggling. Next, look at the payout ratio. This shows how much of the company's earnings go to dividends. A healthy payout ratio is 30 to 50%. Too high, and the company might not afford to keep paying. Another key factor? Dividend growth. Strong companies increase their dividends every year. If a company has done this for 10 plus years, that's a great sign. Also, check the company's debt. Too much debt can make dividends risky. Look for companies with a low debt-to-equity ratio. It means they're financially stable. Finally, research earnings stability. If profits swing wildly, dividends might not be safe. Companies with steady revenue and strong cash flow are your best bet. To sum it up, look for reasonable yields, sustainable payout ratios, growing dividends, low debt, and stable earnings. Get this right, and you'll be well on your way to building reliable passive income. All right, now that you know what to look for, let's move on to how to actually buy these stocks. Chapter 3. Step-by-step guide to buying dividend stocks. It's easier than you think. Step 1. Open a brokerage account. You need a brokerage account to buy stocks. Think of it like an online shopping cart for investments. Some good options include Fidelity, Vanguard, Charles Schwab, or M1 Finance. Just sign up, verify your identity, and you're in. Step 2. Fund your account. Before you can buy stocks, you need money in your account. You can transfer funds from your bank, just like adding money to a digital wallet. Step 3. Choose your dividend stocks. Remember the key metrics we discussed? Use a stock screener to filter stocks based on dividend yield, payout ratio, and growth history. Step 4. Place your order. You'll see options like market orders, buys instantly, and limit order, buys only at your set price. Choose what works best for you. Step 5. Reinvest your dividends. This is crucial. Set up dividend reinvestment or DRIP so your dividends automatically buy more shares. This compounds your growth over time. And that's it. You're officially an investor. Chapter 4. Strategies for Dividend Investing. Now that you've bought your first dividend stock, what's next? Having a strategy. Because smart investing isn't just about picking stocks, it's about growing your money the right way. Strategy 1. Long-term compounding. This is the real power of dividend investing. When you reinvest your dividends, you buy more shares. More shares mean more dividends. Over time, this creates a snowball effect. For example, let's say you invest $10,000 in a stock with a 5% dividend yield. If you reinvest, in 30 years, your investment could grow to over $166,000 without adding extra money. That's the magic of compounding. Strategy 2. Diversification. Don't put all your money in one stock. Spread it across different sectors, like tech, consumer goods, healthcare, and real estate. This reduces risk and keeps your income stable. A great way to diversify? Dividend ETFs. These funds invest in many dividend stocks at once. The S&P 500 Dividend Aristocrats ETF, or NOBL, is a solid choice. Strategy 3. Dollar cost averaging, or DCA. Instead of trying to time the market, invest in a fixed amount regularly, like $10 per day or $100 per month. This helps you buy more shares when prices are low and fewer when they're high. It also removes emotions from investing. No panic buying, no panic selling, just steady growth. The key takeaway: reinvest dividends, diversify your stocks, invest consistently. Stick to these strategies, and you'll build serious passive income over time. Chapter 5. Best dividend stocks for beginners. All right, now let's talk about the best dividend stocks for beginners. You don't need to guess or take big risks. Some companies have been paying and increasing dividends for decades. These are the ones you want. Number 1. Coca-Cola, or KO. Coca-Cola has been paying dividends for over 60 years. It has a solid 3% yield, and it raises payouts every year. People will always buy soft drinks, making this stock a reliable choice. Number 2. Home Depot, or HD. This is a great mix of growth and income. It has a 2.5% yield, and its stock price has been rising for years. As long as people build and renovate homes, Home Depot will keep making money. Number 3. American Tower, or AMT. This is a real estate investment trust, or REIT. It owns cell towers that companies rent to keep our phones connected. It has a 3.1% dividend yield, and as 5G expands, it should keep growing. Number 4. ProShares S&P 500 Dividend Aristocrats ETF, or NOBL. Not sure which stocks to pick? This ETF holds the best dividend stocks, companies that have increased dividends for at least 25 years. It's low risk and fully diversified. The bottom line: these stocks provide steady income and long-term growth. Whether you buy individual stocks or ETFs, the key is to start investing and stay consistent. But before you jump in, let's talk about the risks and mistakes you should avoid. Chapter 6. Risks and Common Mistakes. Listen closely and make sure you avoid them. Mistake 1. Chasing high yields. A 10% dividend yield might look amazing, but it's often a trap. Many high-yield stocks are in trouble and might cut dividends soon. A yield between 3% to 5% is usually safer. Mistake 2. Ignoring dividend safety. Not all companies can keep paying dividends. Always check the payout ratio. If it's over 75%, the company might be paying too much. That's a warning sign. Mistake 3. Not diversifying. If all your money is in one stock or one sector, you're taking a big risk. Spread your investments across different industries to protect your income. Mistake 4. Panic selling. Stock prices go up and down all the time. If you panic and sell, you lose out on future dividends and long-term growth. Stay patient. Play it smart. Avoid these mistakes, and your dividends will keep growing. So, here's what we've learned today. Dividend investing is one of the easiest ways to build wealth. You earn passive income, your money grows over time, and with the right strategy, you can live off your dividends one day. The best part? You don't need a fortune to start. Even investing $10 a day can turn into millions over time. But you need to start now. So, let me recap. Open a brokerage account, choose your first dividend stock, set up dividend reinvestment or DRIP, invest consistently. That's it. Start today, and your future self will thank you. Want to learn how to build a $5,000 per month dividend portfolio? Click the next video.